In yesterday's segment, in yesterday's live segment, we covered the basics of what an option is, what an option contract is, and it got a little bit jargony. It got a little bit technical simply because it's harder when you don't have an actual example to understand and to really kind of bring it home and use normal language to understand these things. And that's what I really want to do with this segment, is to take the learnings we had about what options are in general and apply them to a call option in a way that everybody can understand. So let's go ahead and do that now. So like we talked about before, you either buy or sell an option. And there's only two types of options in existence, a call option and a put option. We'll cover the put later, but today we'll talk about buying a call. And the easiest way to think about what a call is that can make it so everybody can understand it is think of a call simply like a coupon. You're purchasing a coupon, right? So let's get into that. A call option gives the owner of the option the right, or it gives them the option to purchase shares at a specific price by a specific date. So let's use an example. And I'm really hungry, so we're going to use a taco stand as an example because it's one of my favorite foods in the world. So we're going to think about a taco stand here. So call options with tacos. So let's assume that these days taco prices are extremely volatile. They're going up, they're going down by the minute, much like the stock market. So at a point in time, the current price of a taco is $6 in this amazing taco stand. Trust me, I'm sure they're worth it. So you got the option of it, or you could buy the taco right now at $6. The store is running a promo because they know the option, or they know the taco prices are crazy. They're going up and down. So they offer a promotional coupon where you can buy the coupon for $1, only $1 for this coupon, and that'll allow you to purchase tacos for $5.50 at any time in the next 60 days or 30 days or whatever the time frame is. Let's assume here that we're going to say until June 30th, 2018 is the expiration date of the coupon. All right? So right now, that's not a good deal. Now, why is that not a good deal? Let's do the math here. With the coupon and the price of the taco is going to cost a total of $6.50, right? That's the $5.50, which is the redeemable price of tacos, plus the $1 coupon price. So the price that you had to pay to get that coupon. The total cost of that taco is $6.50 right now. And as we said earlier, the current price of a taco is only $6 right now. So you're actually throwing away 50 cents by purchasing that coupon and using it right then and there. But here's where things get fun. What if over the course of the next couple of weeks, tacos increase in price from $6 all the way up to $8.50? That could definitely happen in the taco market these days. So in that example, the coupon for $1 would be a profitable trade. Now, why is that? Because you're still going to pay the same $6.50, right? You paid $1 for the coupon, and the coupon said that you could buy a taco for $5.50. So that price is static. Once you purchase that option, once you purchase that coupon, that your price is set. You know exactly what you can buy a taco for. And with the current price of tacos being $8.50, you have locked in a $2 savings if you were to redeem that coupon right then and there. All right, so going back, now here's the only time we'll get technical on this piece here. I want to go back to the verbiage of an option and kind of bring this back, this coupon example, back to how it would be written if this was an option contract for, let's say, taco stock. There may actually be a stock named Taco. If not, somebody should buy it because that's a pretty cool name for a stock. So if this were an option, the call option would be written like this. You're going to buy one taco being the underlying that you're trading for, at 6/30/2018, June 30th, 2018, call, because this is a call option, at the strike price of $5.50. That's the price you can redeem for a taco whenever you want to in the next until June 30th, at $1. $1 is the credit paid, or I guess I should say the debit that you're going to pay, the price that you're going to pay to get that option, and or if you're selling the option, the credit you would receive for taking on that risk and providing that option to the buyer. So pretty simple, right? And this makes sense. The reason, like, I try to visualize it as well. Why do they call it call? Why is it a call option? And the reason is that the action of saying, I'm going to redeem this, that's calling the option into play. And what you're doing, if you think about it, if you own 5 tacos, let's say you had the tacos in your hand right now, and I have this coupon, the coupon contractually gives me the right to take your tacos. What you're doing is you're calling the tacos away from that person, and you're using them at the price you agreed upon in that contract. So it's the same way with stocks. Let's go ahead and dive into the platform here and show you exactly how you can trade a call option and how easy it is. So let's go back to our grid view here, and let's just find a stock here. Let's do TL. Let's do our good old fashioned SPY. So SPY is the S&P 500 index, and the view that you're going to be presented with first when you click into the table view, if you're using Tastyworks platform, is called the table view. And the way this one works is you have a list of numbers, all sorts of numbers here, but don't be intimidated. We'll walk through what these mean. On the left-hand side of the table, you have your calls. On the right-hand side of the table, you'll have your puts. So we haven't talked about puts yet, so go ahead and just forget about this side of the table and just focus on the left-hand side here. So then the next important thing to know is this line here, and you can see it's where the little green or red bubble is going to be, and there's a horizontal line. That's the current price of the security, of the stock. So here, SPY is currently trading at $275. So you can see that vertical line here is between $275 and $275.50, right? So that's the at the money is what they call it. At the money is really just where the price of the security is at the time. So next you have the bid and the ask. These are 2 columns here. On the call side, they're on the left. And what that shows is the price that's currently being traded, whether you're buying or selling that option. So like we said, you can either buy an option or you can sell an option. So without getting into too much of the nitty-gritty detail, let's go along with the example of buying the option. So to buy an option in SPY or in any security for that matter, what you're going to want to do is click, all you have to do is click on one of the numbers in the ask column. And that's simply because that is the column that represents the selling of the security. Or I'm sorry, the price at which the market is on the upper side. So in this example, we had a taco for $6 and a coupon that we would get it for a little bit cheaper. So let's do that same example here, where I'm going to take the current price and let's go down to $272. If I click there, it's going to show that you're going to buy an option, a call option, and this is 10 days away. So up here you can see we're 10 days away from expiration on this contract, and that's fine for this example. So if we were to buy this, we're going to pay $4.24 for that option contract. Where in our example, we were paying $1 for the coupon. Here, you're going to pay $424 for that option here. And that's because, right, going back to our previous example, every one of these represents 100 shares of stock. So you take whatever number is printed here, and you have to just multiply it by 100. Okay, so how do you find out if or when this is a profitable trade? The easiest way, if you are a new, kind of a beginning options trader, is up at the top here, you see this curve icon, this curve label. If you click that guy, it will bring up a much more intuitive view of the option contract and its relationship here. So what does this tell us? So we basically took the table view and we flipped it on its side here so that now that 275 is right here, but as the stock price increases, we move to the right. As the stock price decreases, we move to the left. So that's the big shift here in looking at it. So let's just go back to the table view. You see how 275 is going down. Here it's going to the right. So that just kind of gets us oriented. This is the movement of the underlying security SPY. So now let's look at some of the other things that are going on here. So the thing that you should be drawn to if you're trading stocks is a big green area. That always means that you're making money, right? We like it when the screen is green. So what this shows is, you can even click on this here, that if the price of SPY winds up being more than $276.20, your maximum possible profit is undefined. And we'll talk about that in a later video about why it's undefined profit. But what you need to know is that 276 is your break-even price. It's when you start making money. Okay? And that's because you bought the option here at, where was this? At 272, you're buying this option, or this call option, and you're paying $4.23 for that option. If you were to take that coupon price and add it to the 275 current price of the stock, because remember, it's like the taco example, right? Just because you can spend some money and get a taco for a little bit cheaper, if you're paying more in net, in aggregate, for that coupon plus the price of the taco, then you're still losing money. So it's the same way here. Even though the strike price is $272, you're paying $4 for that right, for that privilege. So if you were to take $4 off of here, you're really all the way down to $271 to start out with. So you're in the hole a little bit. But if the price moves up to the point of where the 275 and the 429 are added up, that's, what is that? That's 272 plus the $4.32 for the contract there. That adds up to $276.30, which is where you start becoming profitable on the trade. Hope that makes sense there. At the same time, because you're paying $4.30, let's say, or the price is kind of moving around on us here, but because you're paying, let's say, $4.30 for this option contract, the maximum you can lose on this trade is only $430, the price of the coupon. So that is how call options work. That's how you can kind of read them in the Tastyworks platform, and how you can start to understand the profit potential and the loss potential of an options contract. Just real quick, let's go ahead and flip this thing on its head, and let's say that instead of buying the option contract, we were selling it. So let's say we sell that 272 put, and as you would expect, kind of the opposite shows up here. So now your profit range is below the stock price, and your loss range is above the stock price. And we'll cover selling options in just a minute, but I wanted to quickly go over buying a call option first, because that's kind of the easiest way of breaking down options purchasing, options buying and selling, so we all be on the same page. So I hope this is helpful for you guys. If you have any questions, go ahead and leave a comment below, and I will reach out to you in the next video. Take care. Hey guys, thank you so much for watching this video. If you're on YouTube, go ahead and hit the subscribe button and click the little bell to be notified when I make my next video and send it out to you. But even better than that is, if you want to have access to me live as I'm recording this and sharing my portfolio and the ups and downs of my options trading journey, go ahead and head on over to optionengineer.com/group and sign up right there to have instant access to my private Facebook group. It's awesome. There's so many great members growing every single day to become better, more profitable, more exciting options traders. So thank you guys so much for checking it out, and I'll see you on the next one. Take care.